Welcome to the Deep Dive. Today we're going to be looking at Digital Realty Trust Q3 2024 earnings call transcript. It's from the Motley Fool. And yeah, get ready to dive into the financials of this data center giant, server farms, cloud computing, the whole backbone of the digital world. Now I'm joined by our expert to help us break down these complex financials.
Yeah, it's always interesting to see how these companies are navigating the demand, especially with AI and the wider digital transformation that's happening.
Absolutely. So let's just jump right in. What kind of numbers did Digital Realty post this quarter?
Well, they reported core FFO of $1.67 per share for Q3, which is showing some growth, both in revenues and adjusted EBITDA. Their data center revenue jumped by 7.5% year over year, and that was fueled by things like better renewal spreads, those built-in rent escalators, and of course all the leases that have commenced this year.
Okay, so revenue's up. That's good, right?
Well, on the surface, yeah.
Hmm.
But they also had $2.5 billion in capital recycling activity since like mid-2023. So, it's important to consider that when we look at the revenue growth.
So it's not just the top line number, but what's happening behind the scenes too.
Got it.
Got it. What about profitability, though? Did their adjusted EBITDA grow?
Yeah, adjusted EBITDA increased by 11% year over year. And a lot of that was due to a nearly 200 basis point improvement in margin. So they're basically becoming more efficient at turning revenue into profit. And this is largely thanks to those higher data center and interconnection revenues driven by the improved pricing.
So they're squeezing more profit out of each dollar of revenue. That sounds good to me. But I'm curious about their same capital NOI growth. That's a key metric we always look at for REITs, right?
It is, yeah. Same capital NOI growth measures how well they're doing with existing properties. And in Q3, it inched up by 0.8% year over year.
That's not a huge jump, is it?
No, not really. Their data center revenue within those same properties actually grew by a decent 2.5%. But they also got hit with higher operating costs and had to set aside about 200 basis points for bad debt reserves.
So some headwinds there. What did they say about those bad debts? Is that like a recurring issue or something just for this quarter?
It's not totally clear from the transcript, but they do mention that year-to-date same capital cash NOI has increased by 2.6%. But that figure continues to be negatively impacted by about 200 basis points of power margin headwinds year over year. This is due to those elevated utility prices in EMA in 2023.
Okay, so a mix of factors there. But let's move on to their leasing activity. I heard they had a record-breaking quarter.
They did. Digital Realty signed $521 million in new leases. That's more than double their previous record. And the CFO, Matt Mercier, he broke it down a bit further. $450 million were those larger, greater than 1 megawatt leases, mainly in the Americas. Another $50 million were from those 0 to 1 megawatt leases, and then $16 million came from interconnection bookings.
Wow. So strong performance across the board. It seems like they're really riding the wave of this huge demand for data centers.
It does seem that way. The CEO, Andy Power, he acknowledged there might have been a little bit of a pull forward in demand, but he really emphasized that they are nowhere near reaching a saturation point.
So no worries about demand drying up anytime soon.
Not at all. In fact, their backlog of signed but not yet commenced leases has surged to a record $859 million. And that represents a huge 20% of this quarter's annualized data center revenues. And they expect over 85% of those leases to actually start generating revenue by the end of 2026.
That's a pretty significant pipeline of future revenue. But all this growth has to require a lot of investment. What did they say about their development activity?
Well, they spent $651 million on development just in Q3, with gross spending at 100% share reaching $855 million. This was driven by the need to meet that demand we talked about. They actually doubled their development projects in the Americas and added more in the EAA. This has all led to almost a 50% increase in their pipeline.
So they're pouring money into expansion. Can they handle that financially, though?
That was a concern raised by Jonathan Atkin from RBC Capital Markets in the Q&A. He asked specifically about, the implications for future CapEx levels and how they were planning to balance those investments with their leverage goals.
What was their response? Did they address those concerns?
Yeah, Mercier, the CFO, he confirmed that they were on track with their capital expenditures for 2024. He added that while he'd provide more specific guidance in Q4, he didn't expect 2025 CapEx to be lower than 2024.
So they're basically saying, hold tight, we got this.
Pretty much. And they also emphasized their efforts to make their balance sheet stronger. They actually raised over $800 million in equity through an ATM offering and then issued an $850 million green bond during the quarter.
But there's some big numbers.
Yeah.
Did they talk more about how they're managing their debt?
Mercia highlighted that they were already at their target leverage levels and had $5 billion in liquidity, and apparently they've already funded their plans through 2025 while aiming to stay within those leverage targets. So it seems like they're confident about their ability to fund this growth without, taking on too much risk.
Okay, that's reassuring. But let's dig a little deeper into what's driving this demand. We've talked about the overall growth, but what's fueling it? Is it all about AI, like some people are saying?
AI is definitely playing a big role. It accounted for roughly 50% of their bookings this quarter. But Andy Powers was quick to point out it's not just an AI story. The core demand fundamentals that were there before all this generative AI stuff are still there and they're still growing.
Okay, so it's a combination of factors.
What
What are some of the other drivers they mentioned?
Power highlighted the continued growth of cloud computing and things like digital transformation initiatives across industries, and of course, the need for hybrid IT solutions. These are trends that have been driving data center demand for years, and they don't seem to be slowing down anytime soon.
So it's like a mix of old and new, right? The traditional drivers are still there, but AI is adding this new layer of demand on top of that. It seems like a really dynamic market.
It is. And during the Q&A, Michael Rollins from Citi asked a really interesting question. He asked about, whether this exceptional demand might be pulling forward Digital Realty's natural opportunity. He was essentially asking if this was a temporary surge or more sustainable growth.
That's a great question. What did they say about that?
Power acknowledged there might have been some minor pull forward, but he insisted that the demand is far from being saturated. To make his point, he said some of their biggest deals in Q3 were for capacity blocks, located right next to almost identically sized blocks. These blocks have power coming online soon, and they're in key markets like Manassas Ashburn and Chicago. It's like they're selling out as fast as they can build.
That's pretty compelling.
Yeah.
But those are all established data center markets. What about their plans for expansion? Are they looking at any new markets?
Eric Lupchow from Wells Fargo asked a similar question during the Q&A. He specifically asked about how Digital Realty planned to maintain its runway for growth, given how quickly they're leasing up capacity.
Do they shed any light on their expansion strategy?
Power responded by talking about their phased development approach, especially for Northern Virginia, which is a major data center hub. They've got adjacent buildings in Ashburn and Manassas with almost 100 megawatts of IT load each. These are ready to come online in late 2025 or 2026. And then further out, they have another 230 megawatts in the next wave of buildings. And the power for these will be delivered as those substation components are finished.
So they have a clear roadmap for expansion in their existing markets.
Yeah.
But what about going into new territories?
That's where it gets interesting. Power brought in Greg Wright, their chief investment officer, to talk about their land acquisition strategy.
Okay, let's hear what Mr. Wright had to say. I'm curious about where they're planning to expand next.
Wright started by highlighting just how much land they already have. He said they have over 3 gigawatts of buildable capacity on their balance sheet across various markets. And he thinks that's a substantial pipeline that very few others can match.
So they're sitting on a lot of potential. But are they actively looking for more land to fuel future growth?
Wright explained that their main focus is on buying land in their existing markets where they already have a strong presence. He mentioned activities all over the globe, including North America, South America, Europe, Africa, and some key markets in Asia Pacific.
So they're deepening their roots rather than spreading themselves too thin.
Exactly. They're being strategic and disciplined with their expansion, prioritizing markets that have proven long-term potential. Wright did say they are considering some new markets, but he made it clear that wouldn't be the main driver of their development growth.
That sounds like a prudent approach. They're being careful not to overextend themselves.
Definitely. They're taking a measured approach, focusing on maximizing returns in their core markets, while also keeping an eye out for strategic opportunities in new territories. They're trying to strike a balance between growth and risk management.
Okay, so they're expanding strategically. But they're also facing those challenges with power availability. Earlier, you mentioned that CEO Andy Power talked about the lengths hyperscalers are going to secure enough power. Can you tell me more about that?
Sure, Power gave some crazy examples of what hyperscalers are doing to make sure they have enough power. We're talking deals to revive the 3 Mile Island nuclear plant, a hyperscaler teaming up with a utility to build small modular reactors, and another one securing power purchase agreements for nuclear energy from future small modular reactors. These are not small moves.
Wow, those are some serious power plays.
Right. And Power's point was that these power plants are still years away from actually generating electricity. This really highlights the value of having readily available capacity blocks right now and for the next few years.
Yeah, it makes sense. If you're a hyperscaler with these huge computing needs, you can't wait years for a new power source to come online. You need that capacity like yesterday.
Exactly. And Power also stressed that getting the power is only one part of it. Customers also depend on Digital Realty for the whole package, supply chain management, construction expertise, and the know-how to actually run these complex
So
facilities.
it's not just flipping a switch. They're providing a complete solution for their clients.
That's right. They're building and operating these digital cities, and that takes a lot more than just raw power.
This is already fascinating, and we've barely scratched the surface.
Yeah.
What else can we expect from the rest of our deep dive?
Well, we still need to unpack their full spectrum product strategy, especially their performance in that 0 to 1 megawatt plus interconnection segment. And we haven't even touched on their efforts to strengthen their balance sheet and their overall guidance for the rest of the year.
There's definitely a lot more to explore. This is turning out to be a real deep dive.
It really is. And as we go deeper, keep in mind that question about long-term sustainability. Can Digital Realty really keep up with this incredible pace of growth? It is a million-dollar question.
Hmm.
And it's one that analysts wanted to know more about during the Q&A. Irvin Liu from Evercore ISI, he pointed out that Digital Realty had mentioned accelerating growth a couple times, and he recalled their earlier comments that 2025 growth should be around mid-single digits. He was wondering if their current commencement schedule was like hinting at any potential upside to that growth expectation.
So Wall Street's expecting them to do even better than their own projections. That's interesting. What did Digital Realty have to say about that?
Mercier answered this one, and he repeated their target of mid-single-digit growth for 2025. He reminded everyone they set this target while they were also actively trying to decrease their debt over the past, 12 to 18 months. So basically, they wanted solid growth, but also wanted to improve their financial health at the same time.
Makes sense. You don't want to grow too fast and risk your balance sheet. But going back to Lou's question, did they hint at all about maybe exceeding that mid-single-digit target?
Mercier didn't give specifics, but he did emphasize their commitment to improving the company's long-term sustainable growth profile. He even said they were seeing positive results from their efforts already, with some of those improvements showing up on the bottom line faster than others.
Okay, can you give me an example? What kind of improvements are we talking about here?
Sure, so he explained that their renewal spreads in the 0 to 1 megawatt segment are already having a more immediate impact on their financials. On the other hand, the benefits from the greater than 1 megawatt segment are mostly reflected in their backlog, which is already at $350 million for 2025 and a massive $300 million for 2026.
So they're setting themselves up for strong growth in the next few years, even if they don't blow past their targets.
It looks that way. Mercier's main point was that this quarter's performance really helps de-risk their plan to achieve their stated goals. And it provides a really solid foundation for accelerating growth, not just in 2025, but after that too.
Okay, so they're being cautious, but they're definitely confident. But let's change gears a bit and talk about their full spectrum product strategy. Earlier, you mentioned their 0 to 1 megawatt plus interconnection business. What can you tell me about that?
This is where it gets exciting. You see those big hyperscale deals get all the attention. But Digital Realty is also doing really well in this segment, which is more for smaller businesses. They actually had record bookings of $66 million in this category during Q3 and a record 149 new logos. This shows they're not just going after the big companies, they're building a more diverse customer base.
So they're casting a wider net.
Mm-hmm.
Makes sense for long-term stability.
Exactly. It all ties back to that idea of sustainable growth. Having a mix of customers, big and small, helps protect them from changes in any one market. It's like having a diversified investment portfolio.
I like that analogy. It makes perfect sense. But how are they attracting all these smaller businesses? What's their strategy?
Michael Elias from TD Cowen asked almost the same thing during the Q&A. He was curious about what was driving their great bookings in the enterprise segment.
What did they say about that? Did they share their secret?
Power admitted that their efforts to make their platform more attractive to enterprise customers have been going on for years. They've been investing in things like infrastructure, power density, and connectivity. They're basically creating a one-stop shop for different needs, hybrid IT, cloud, AI solutions.
So they're making it easier for companies of all sizes to use their expertise and resources.
Yeah.
What about pricing, though? Are they offering any discounts to get these smaller customers?
Actually, they've been doing the opposite. Power said they've been focusing on keeping a strong value proposition, and that's meant adjusting their pricing. They've had success increasing their asking rates and getting higher renewal spreads, especially in that 0 to 1 megawatt segment.
So they're not afraid to charge a premium.
Yeah.
They know they have a good product, and they're not shying away from that. But can they keep this up? What about competition?
Competition's always there, especially in an industry as fast-moving as data centers. But Digital Realty seems confident. They have a global reach, a strong track record, and they really understand the market. Plus, they're always innovating and investing in new technologies. All of that gives them an advantage.
Okay, so they're in a good spot. But let's get back to the financials for a second. Earlier, we talked about their efforts to strengthen their balance sheet. Did they say anything else about that?
Yeah, Mercia highlighted their debt profile. He pointed out that their weighted average debt maturity is over 4 years, and their weighted average interest rate is 2.8%. He also mentioned that about 85% of their debt isn't in US dollars, which reflects their global platform and their foreign exchange hedging strategy.
So they're managing their debt well, spreading it out over different currencies and maturities. Smart way to reduce risk. What about their overall guidance? Did they give any updates on what they expect for the rest of the year?
They did. They actually raised their core FFO per share guidance for all of 2024. The new range is $6 to $6 to $6.75. They increased the low end of the range by 0.05 cents per share and kept the high end the same. Mercier said this increase was because of the strong leasing and commencements they've seen so far this year, and because of the better-than-expected renewal pricing.
So they're raising their guidance even with things like those customer bankruptcies and balance sheet changes.
Yeah.
That's a good sign, right?
It does show that they're feeling good about the rest of the year. And looking ahead, they said their growth is likely to speed up from 2024 levels. This is because of the strong fundamentals for data centers and their big backlog of leases.
So they're painting a pretty optimistic picture of the future. But as we wrap up this deep dive, what's the main takeaway? What should listeners be thinking about as they consider Digital Realty's performance?
I think the biggest question is sustainability. Can they keep up this impressive growth over the long term? They've got challenges with power availability, rising interest rates, and more competition. And like we've seen in real estate, things can go down just as easily as they go up.
That's true. It's easy to get excited about record-breaking quarters and optimistic forecasts, but the future is never certain. There are always risks to think about.
Exactly. So as we look ahead to Digital Realty's Q4 earnings, the big question is, can they keep exceeding expectations, or will they eventually be affected by the market?
Yeah, that's the question, isn't it? Will they be able to keep it up? But I think for now we've done a pretty good job covering what's going on with Digital Realty, their current position, all that.
Yeah, definitely. I think we hit all the main points, their financials, their growth strategy, and even some of the challenges.
And something that's really stood out to me is just how big their operation is. It's not just building data centers. It's more like creating these huge digital ecosystems.
That's a great way to put it. They're like the architects of the digital world, building the infrastructure for everything, cloud computing, AI, the whole thing.
And it's all happening behind the scenes.
Yeah.
Most people don't even think about it.
Right. But it's so important. Without data centers, our digital lives would just stop.
That's true. It really makes you think. But get back to Digital Realty. What are your final thoughts? What should listeners be looking out for as we go into the next quarter and beyond?
Well, I think the next earnings call will be really interesting. We'll see if they can keep this momentum going, especially with the economy being a little shaky right now.
Yeah, that's true. Rising interest rates, inflation, the global situation, it could all affect their business.
For sure. And I'd be watching their development pipeline closely. Can they actually pull off those big expansion plans? Can they get the resources, especially power, to keep up with this demand?
And can they do it all without going crazy with spending? That's the key, right? Growth is good, but not if it means sacrificing long-term stability.
Exactly. So the question is, can Digital Realty be ambitious and smart at the same time? We'll have to wait and see.
Very well said. And I think that's a great place to wrap things up. This has been a really insightful deep dive. I appreciate you taking the time to share your expertise.
Happy to do it. Always enjoy getting into these topics.
And to our listeners, thanks for joining us on this journey into the world of data centers. Until next time, stay curious.